Kenya's economic landscape has in the last decade witnessed the rise of the financial services sector and more specifically the banking industry. What hasn't quite changed though is the high cost of borrowing from commercial banks as depicted by the wide gap between what the banks pay on deposits and what they charge on loans. To help narrow that gap, the government is set to introduce a new benchmark interest rate, a move that will take away the discretionary power that banks have enjoyed over the years to set their individual base rates. The rate, known as the Kenya Bank's Reference Rate, or KBRR, will be set every 6 months by the Central Bank's Monetary Policy Committee based on a 6-month average of the central bank rate and the 91-day Treasury bill rate.
The new reference rate will be a public number that you can be able to track. It will be monitored by all the players and it will be set by the central bank. So when it moves, you already know where it has moved and you can anticipate the movement.
But banks will be given a leeway to add a premium on top of that rate, a markup that will price in all other risks and overheads attached to the loan. That margin will, however, vary from one bank to another, thus opening up Pandora's box as to whether the cost of borrowing will really come down.
There are about 12 different charges that are not related to interest rates.
This is especially worrying going by an analysis that was conducted by the Central Bank of Kenya and the World Bank, which indicates that the profit markup on loans has increased over the last 2 years. According to the study, profits accounted for 55% of the difference between the interest rates paid on deposit and that charged on loans in 2013, up from the previous year's share of 48% of the spread. This was despite overheads borne by banks having gone down to 37% from 47% in just 1 year.
For a bank to remain at 18%, they just need to front load 10% on that or 9% on that for them to maintain their existing pricing framework.
What is not in doubt, though, is that individual borrowers are poised to have a greater power to negotiate where to borrow from and at what rate.
The consumer, because of the fact that he can now be able to compare across the prices, banks are then now able to compete on the basis of price. Now, when they start competing on the basis of price, then the market forces come into place. And those market forces are what's going to bring the cost of lending down.
You're supposed to know exactly, apart from the interest rates, what else are you being charged? So you can make your decision.
While analysts expect the government's latest policy shift to spur competition within the banking sector through transparent pricing of loans, the unanswered question remains: when will the lending rates come down to single-digit levels? Bella Genga, Monday Special.